What if your bank could move value across borders in seconds with minimal pre-funding using a digital bridge asset instead of a web of nostro accounts? In this module, we'll unpack how Ripple and RippleNet's on-demand liquidity aim to make that possible, and what that means for your operations, risk, and customer experience. RippleNet is structured like a payment stack your bank can actually plug into. At the base, integration APIs connect directly into your existing treasury and payment systems, so you don't have to rip out legacy infrastructure. Above that, a rules and SLA engine coordinates how participants behave. Cutoff times, FX practices, dispute handling, and performance guarantees are all defined up front. On top sits a shared messaging standard that specifies exactly what data travels with each payment, making cross-bank reconciliation, compliance checks, and tracking much more predictable. Connecting to RippleNet is about more than just hitting an API. The harder work is how your core systems, payment hub, and channels feed the right data into that API in real time. You still need KYC and KYB details, payment instructions, FX quotes, and status updates flowing cleanly end-to-end. Whether you connect directly or through an aggregator PSP, your reconciliation, exception handling, and reporting processes have to be reshaped for an always-on world with instant feedback. Pre-funded nostro accounts feel safe, but they're highly inefficient. You lock up capital in multiple countries, just in case payments arrive. That cash sits idle, earning little or nothing, instead of supporting loans or investments. Because balances are scattered, it's harder to optimize liquidity, while operations teams absorb constant reconciliation work and investigation overhead. On-demand liquidity inverts the old model of parking cash in nostros. Instead of pre-funding each corridor, a digital asset like XRP is used as a bridge only when a payment is actually sent. Fiat in the source country is converted to XRP, moved across the network in seconds, then sold for local currency at the destination. Capital is mobilized just in time for the payment, then released back into your control. To do this at scale, you need deep exchange liquidity, competitive FX spreads, and enough regulatory clarity to hold and trade the asset with confidence. On-demand liquidity turns a traditional fiat-to-fiat payment into a very short digital detour. The sender still pays in local currency, but instead of relying on pre-funded nostros, that fiat is converted into a bridge asset on an exchange. The bridge asset moves across the ledger in seconds, then is sold into the destination currency and paid out locally to the beneficiary. In effect, you're replacing hold cash everywhere in advance with source and settle liquidity on demand at the moment of each payment. Moving FX execution on-chain means you're managing timing, rates, and failure conditions together. Deterministic finality in a few seconds creates a tight window where the FX rate must hold, so liquidity providers pre-commit via code to buy or sell at specific prices instead of via phone calls. Around that, you define risk controls. Quotes auto-cancel if markets move beyond a set tolerance. Both conversion legs can also be bundled into a single, locked FX rate, so operations and accounting see one clean number instead of two separate exposed trades. You can think of instant cross-border payments moving through a compliance tunnel. At the entry gate, you fully vet the sender. KYC, sanction screening, and AML checks are completed before you trigger the on-chain leg. As the payment travels, required travel rule data rides with the value, so regulators can see who sent what, to whom, and for what purpose. At the exit gate, you validate the beneficiary and apply local privacy and screening rules. Over all of this sits licensing. How the bridge asset is classified determines which regulatory permissions and controls you need. Evaluating a network like RippleNet means looking beyond speed and fees and using a structured lens. Legally, you ask, which contracts, rulebooks, and jurisdictions govern these flows, and are they enforceable if something goes wrong? For financial risk, you examine who holds digital assets, how volatile they are, and what happens if an exchange or liquidity provider fails. Operationally, you review resilience, vendor dependency, and incident response arrangements. And on compliance, the question is whether this can plug into your existing KYC, sanctions, monitoring, and audit stack without creating blind spots. Correspondent banking was built for a time when speed and transparency were secondary. A single payment may hop across multiple intermediaries, each with its own ledger, cutoff times, and compliance checks. So end-to-end settlement often takes T+1 to T+3 instead of minutes. At every hop, new fees and FX spreads can appear, often without a clear breakdown for you or your customer. All the while, pre-funded nostro balances sit idle across many banks, trapping liquidity and amplifying FX risk across each corridor you support. Ripple's on-demand liquidity aims to compress that traditional chain of correspondent banks into a single, near-instant hop. The core promise is that funds move in a few seconds, not days, with FX and fees locked in upfront before you commit the payment. Because liquidity is sourced at the moment you send, you no longer need to maintain large pre-funded nostro balances in multiple currencies. For a bank, that can mean faster delivery, clearer transparency for customers, and a lighter balance sheet footprint across active corridors. Comparing correspondent banking with Ripple ODL is about understanding trade-offs, not expecting magic. On liquidity, you move from static, pre-funded balances to just in-time digital liquidity. That can significantly improve capital efficiency by freeing trapped cash, but only if you're comfortable holding, converting, and settling through digital assets. Risk also changes character, away from multi-bank credit exposure toward market, exchange, and operational risk on the new rail itself. In return, speed and customer experience shift from batch-based multi-day settlement to predictable, near real-time delivery and confirmation. When deciding where to deploy Ripple-style on-demand liquidity first, focus on 3 sweet spots. High-volume remittances, where payments are small but constant, benefit from faster settlement and reduced working capital needs. Semi-payments come next. Mid-market corporates dislike opaque correspondent fees and delays, so clean, predictable on-chain FX is a clear advantage. And exotic corridors where nostro pre-funding is especially expensive can suddenly become economical. Across all of these, you still need 2 green lights before you switch on volume: sufficient regulatory clarity and enough corridor liquidity.